Welcome back to The Explainer. Today, we're diving into a really fascinating intersection of high-stakes finance and cutting-edge medical science. We're unpacking Dianthus Therapeutics. They're a clinical-stage biotech company that just dropped their Q1 2026 financial results, along with some massive updates to their clinical pipeline. Now, if you follow biotech at all, you know it's a world defined by high risk, high reward, and frankly, astronomical cash burn. But Dianthus, they're sitting on a war chest that is seriously turning heads on Wall Street. So we're going to break down exactly what they're building with all that capital, the science behind their next-gen therapies for severe autoimmune diseases, and why these next few years are absolutely critical. All right, let's jump right in. Here's our roadmap for today's explainer. We've got 5 quick chapters to help us digest all this biotech data. First, we'll look at that billion-dollar war chest. Second, a breakdown of those Q1 financials. Third, we're exploring their neuromuscular pipeline, specifically their drug Claseprubart. Fourth, we'll check out DNTH212 and their big push into rheumatology. And finally, we'll wrap up with analyst views and the upcoming catalysts you definitely need to watch. Okay, Chapter 1, the $1.2 billion war chest, capital for growth. You know, in the clinical stage biotech world, cash is literally the oxygen that keeps the science alive. And Dianthus? Well, they're breathing easy. As of March 31st, 2026, they held a staggering $1.2 billion in cash equivalents, and investments. Just to put that in perspective for a second, $719 million of that total came from a massive upsized public offering they just closed in March. Basically, they went to the market, and the market handed them nearly $750 million. No big deal, right? But here's the crucial point, and it's what that number actually means for the company's future. That cash pile isn't just a trophy to sit on a balance sheet. It translates to an expected operational runway deep into the year 2030. In an industry that is frankly notorious for insane burn rates, where companies are constantly having to pause trials or dilute shareholders just to keep the lights on, having funding completely locked down for the next 4 years is a massive competitive advantage. It means their scientists can just focus on executing the trials, rather than constantly worrying about fundraising. Moving right along to Chapter 2, Q1 Financials, Tracking the Burn. So if cash is the oxygen, expenses are the fuel burning in the engine, right? Looking at how they're deploying this capital, you'll notice the net loss widened to $40.8 million, up from $29.5 million the previous year. Research and development expenses also jumped up to $34.5 million. Now, in a normal, traditional company, widening losses might be a huge red flag. But for a clinical stage biotech, this is exactly what analysts want to see. This increased spend directly reflects their expanded clinical activity. They're ramping up headcount and funding these incredibly complex Phase 2 and Phase 3 trials. So they are actively putting that $1.2 billion to work. All right, Chapter 3, Claseprubart Pipeline, Neuromuscular Focus. So what exactly is all that money funding? The first major pillar of their pipeline is a drug called Claseprubart, which is also known as DNTH103. And they recently got a huge win for this active C1s inhibitor. The FDA just granted it orphan drug designation for the treatment of myasthenia gravis, or gMG. This is a really big deal. The FDA hands out this special status to encourage the development of treatments for rare diseases, specifically those affecting fewer than 200,000 people in the U.S. And what it does is it sets Dianthus up for potentially faster regulatory processes, tax credits, and crucially, up to 7 years of market exclusivity if it gets approved. It basically creates a powerful protective moat around their investment. But they aren't stopping at myasthenia gravis. They're also targeting CIDP. Now, to understand this disease, think of myelin like the protective insulation on the electrical wires inside your house. In CIDP, the body's own immune system mistakenly attacks that insulation around peripheral nerves. And when that insulation is damaged, the nerve signals slow down, or they just fail completely. This leads to progressive weakness, numbness, and poor coordination. It is a severely debilitating condition, and there's a massive unmet medical need here. And honestly, here is where the momentum is really starting to build. Dianthus recently announced an early go decision in Part A of their Phase 3 Captivate trial for CIDP. Their target was to see 20 confirmed responders. While they hit that milestone early, with fewer than the 40 planned participants even needing to complete Part A. Hitting that target early like that, it builds incredibly high confidence in the drug's efficacy and potency as it moves forward. And that regulatory momentum is already accelerating their clinical trials. Dianthus actually secured written agreements from the FDA that seriously simplify how they run these studies. They got the FDA to remove certain antibody screening criteria that were previously causing patients to fail screening altogether. They also managed to get a hypothetical risk of systemic lupus reclassified to a much more manageable drug-induced lupus classification. Why does all this matter? Well, it lowers patient friction and makes it much easier to enroll people in the trials. Plus, here's the most reassuring fact: 0 cases of either lupus-related side effects have been observed in any program to date.
Chapter 4, DNTH212 Expansion, Rheumatology Franchise.
So, if Claseprubart is the foundation of their neuromuscular franchise, DNT212 is their aggressive expansion into rheumatology. To really get what DNT212 is, you have to understand the concept of a bifunctional fusion protein. The easiest way to think about it is like a molecular Swiss Army knife. Instead of just having one tool, it has two. It simultaneously targets PDC-BDC2, which reduces type 1 interferon production, while at the exact same time inhibiting BAFF and APRIL, which suppresses B-cell function. By targeting both the innate and adaptive immune systems at once, it's aiming for a much more powerful and differentiated effect than those older single-mechanism drugs. Just recently, in May 2026, Dianthus formally announced exactly where they are pointing this Swiss Army knife. They've selected Sjogren's disease, systemic lupus erythematosus, and dermatomyositis as their first 3 priority indications. These are incredibly complex autoimmune conditions, and patients desperately need better options. Selecting these 3 officially establishes their synergistic rheumatology franchise right alongside their neuromuscular work. Which brings us to Chapter 5. Analyst catalysts and market valuations. Okay, so we've seen the science and we've seen the bank account. But how is the market actually valuing all this progress against Dianthus's roughly $2.98 billion enterprise value? Well, Wall Street is looking at this data with deep optimism. Out of 15 analysts polled, the consensus rating is a strong buy. At the time of this data in late May 2026, the stock was trading around $86.48. But get this, the average analyst price target sits at $125.83. That represents a potential upside of over 45%. The market is very clearly pricing in the potential of that long cash runway and those early trial successes. But, to truly understand the landscape here, we have to look at both sides completely impartially. The bull case points straight to that unprecedented $1.2 billion runway into 2030, the early phase 3 success we saw in the Captivate trial, and the really smart expansion into 2 distinct franchises. Conversely, the bear case highlights the harsh reality of biotech. The net losses are widening, the recent $719 million raise obviously brought massive share dilution, and ultimately, this entire valuation relies heavily on unproven binary trial readouts. If the science fails in late-stage trials, well, even $1 billion cash pile won't save the stock price. So, the million-dollar question: when will we know? Let's take a look at the catalyst calendar. Investors are going to be watching mid-2026 closely as the Phase 3 EMERGE trial for myasthenia gravis officially kicks off. Then, in the second half of the year, we'll get Phase 1 data for DNT212. By Q4, we're expecting top-line results for the Phase 2 MOMENTUM trial. And looking a bit further out, the second half of 2028 will bring the absolutely critical Phase 3 EMERGE top-line results. Each one of these dates is a massive potential inflection point for the company's valuation. Which really leaves us with the ultimate question. Dianthus Therapeutics has built an incredible financial moat, and they've generated some truly compelling early-stage science. But with a massive war chest stacked against the binary pass-or-fail stakes of clinical trials, will their next-generation therapies successfully cross that FDA finish line by 2030? The runway is clear, for sure, but the science still has to fly. Thank you so much for joining me for this explainer, and definitely keep your eyes on those upcoming Q4 catalysts.